Good. So now we can see in a second why reserves are so important. Let's see, in this example here, we didn't have any trouble. We have here 10 as exchange settlement fund in the beginning, 100 in deposits. They're transferring 5, or one of their customer is transferring 5, and they've got 5 ESF left over. So it's nice and easy. And this one is called interbank settlement, so if banks pay each other. And if they have enough liquid funds, so if there's enough ESF, reserves, cash around here, it's easy for banks, it's not a problem. And there's an economic function behind that one too, what they're doing. Because when you look at this one, deposits, 100. Are deposits considered liquid or illiquid? When you have your deposit account, do you believe you can get your money any time, or do you have to wait a week or two? Do you have to call your bank first, give them a warning, I want to transfer some money? It's due any time, immediately due, right? So very, very liquid funds. Or say slightly different, very, very short maturity. They are mature immediately if you want to have them. So there's 100 in liquid liabilities, but let's look at the assets. The cash, of course, is very liquid too, and the ESF is very liquid too. But the loans, are they liquid? Not at all, right? So these one would be 20, 30-year loans. If my bank is calling me and say, listen, you've got X $100,000 in mortgages with us. We want to have $50,000 back today because we need to pay somebody. Tough luck. I'm certainly not going to pay them $50,000 today. Right? So the loans are very, very illiquid. But look at the mismatch here. In the economy, if you look at all the customers here, what do they believe in a dollar value? How much liquid funds do they believe the bank has? How much liquidity do the customers feel? Any of these customers believes that they can't withdraw their money? All of them believe they could withdraw their money any time. But is that true? No, right? The bank has only 10 in cash lying around. So basically what they're doing is they're doing kind of a trick here. They have illiquid assets, but they're creating out of that one liquid deposits. Or say it's slightly different, they make out of liquid deposits illiquid assets. And that's a very important economic functions, because in the economy there's lots of people that want to have long-term borrowing. But there's not many people that want to commit to long-term lending. And the banks can match these two. Because now here, these are all short-term savers. They're saving basically just for 10 minutes because they believe they can withdraw their money anytime. But we can make out of this lots of 10-minute savings 30-year mortgages. But that comes at a certain cost for the bank. So if the bank has here just $5 in transfer of its customers, it's nice and easy, not a problem. And if they have ESF, more than 5. But let's look at the next slide here. Now their customers want to transfer $20, and of course they've got $100 in checkable deposit, so why not transferring $20 to another bank? It's your right to do it, it's your deposit. But look at where the problem is now. If First National Bank wants to pay the other bank $20, where's the problem? There's plenty of deposits, but what's missing? ESF, right? Because banks have to pay each other via their ESF, and they only have 10. So now this bank is facing a massive problem. So let's see what we can do. $10 they can push over off their RBA account towards the Second National Bank RBA account, nice and easy. But then there's still $10 left over, and they can't do anything in that moment. So in that moment, they just have to write down, well, we still owe the other bank $10. So $20 came immediately off the customer, but here, now they still owe the Second National Bank $10. And I wrote here on purpose, instead of loan, unknown little company, I call this one, bonds. So they invested in bonds in the past. Now let's see what the bank can do. Somehow they have to still pay Second National Bank. They clearly don't have any cash, they don't have any exchange settlement funds. So what can they do? One possibility is they try to sell the bonds. But if you have an unknown little company, how easy is it to sell the bonds? Very hard. Possibly you have to sell them at a massive discount, very, very, very cheaply, that somebody is willing to buy them. So then the bank would make a loss. And banks, of course, don't like making losses. Or an alternative would be they can ask Second National Bank, listen, we're a bit tight right now. Can we repay you tomorrow? or can we repay you next week or next month? So basically, you can ask Second National Bank for a loan. That would look in the balance sheet the same. But what do you reckon Second National Bank says? Sure, pay me whenever. No, they want to see cash too. So they want to earn interest. If they give a loan to First National Bank, they want to get paid interest. And the interest is most likely not going to be super cheap either. So again, it's going to cost First National Bank something. And the third one is ask the Reserve Bank of Australia for an emergency loan. And again, the Reserve Bank of Australia might say yes. But again, they are going to charge interest rate for that one. And that interest rate is a very, very famous interest rate. That is the so-called cash rate. The banks lend to each other in between. That's actually the cash rate too for one night. Well, that's the one that you see in the news very often, that the RBA is targeting, and that they are possibly changing. First Tuesday every month they have the meeting where they're deciding if the cash rate should go up, down, or stay the same. That's the cash rate that you have learned in macroeconomics about. So in our class, the cash rate is important because it's showing us kind of the opportunity cost of running low on exchange settlement funds. All these things we will do more in future classes. I just want to give you a little bit of a feeling for it. The main point here is if you have too little exchange settlement funds, number one, you're so-called illiquid. You have too little liquidity. Number two, it's going to cost you. It's either going to cost you by making a loss on selling something urgently, or it's going to cost you by borrowing from another bank at a high cost, or it's going to cost you because you have to borrow from the RBA at a high cost. But it's for sure not for free. Right? Illiquidity is costly. And how we manage this, next few weeks we talk about. Now that you know about illiquidity, let's look at these funds and play around with that one a little bit. One withdraws $99 from his account at Bank A. So withdrawal means cash withdrawal. And then we have here, Eva uses her deposits to repay her loan. There's $100 basically in the cash machine, you can imagine, or behind the counter. People come in, want to withdraw 99, so there's now only $1 left. Deposits, because they withdrew the money off their deposit account, the bank now owes them only 500, not 599. By the way, they can see, very important for our class, deposits is not cash lying around. Deposits is for us an asset, but for the bank it's simply a liability, something that they know they have to repay us in the future. But we've got over here Eva. Let's say this is all Eva's deposits and Eva's loan. So if she's using her deposits to repay her loan, they just cancel out. So her $200 loan disappears, so she doesn't have to repay the bank in the future $200 anymore if she repays it now. But at the same time, the bank doesn't owe any deposits to Eva either, so her deposits are gone too. And all the other numbers stay the same. Liquidity risk. So look at these numbers. Which bank has the highest illiquidity risk? A, B, C, or D? So illiquidity risk is, of course, the risk that I'm running out of. Well, I'm not giving you the answer yet. So here the main kicker is, it's tempting to just look at how much cash they've got, but that's not enough. Illiquidity risk is a combination of how much liquidity you have and how big the chance is that you're running low. And because B has much, much more deposits, the chance that $50 are transferred or withdrawn is much bigger than here the chance that $10 are withdrawn. Because this one here is, basically it's a ratio between deposits and liquid funds. So here the ratio is 10%, here the ratio is only 5%. So if you have 5% of all your short-term liabilities covered by short-term liquid assets, the chance that you're running low is much bigger than if you have 10%.